Welcome to the KPC Smart Money Podcast. And today we picked a topic that I bet is on a lot of your minds. Are we in a bear market now? And you know, when we talk about bear season, sort of in nature, hikers are always advised to stay off the trails and carry pepper spray.
Stay on their trails.
Oh, stay on. Oops, yeah. That was bad advice. Okay, so you got to
trying to get people killed.
Now stay on your trail, carry your pepper spray, and that goes on for a couple of months. Well, guess what? It came a little early for investors this year. The S&P 500 index of leading American stocks has fallen by about 18% from its all-time high in January, 10 percentage points of which was in the last month alone. So now, the S&P is flirting with bear market territory defined as a 20% decline. If you had money in the NASDAQ with, tech-heavy, which is a tech-heavy benchmark, well, it has actually plunged into the bear market. Since November, it has shed 29%.
Yeah. So, Karen, the last bear market we had was during COVID, March of 2022. But people have kind of forgot about that because by the end of the year, it corrected, right? It was kind of a fluke, but that's not true anymore, is it?
Well, here was the difference. COVID was because of a very specific situation, shutting down the economy, etc. Now I think what most people realize, the issue now is we do have problems with the fundamentals in the economy. We really do have inflation. We really do have an idiot who shut down our gas independence. We really do have fundamental economic problems.
So much for staying away from religion and politics.
Hey.
It's our podcast. We can do what we want.
Yes.
Okay.
It's not going to Facebook. They can't censor me.
Like they have so many times.
Yes.
Okay. Well, if you're just looking at the NASDAQ, say the NASDAQ 100, there's an actual fund called QQQ that is the NASDAQ, tech-heavy benchmark, right? That is in a bear market, but a technical bear market is a sustained 20% decline. So we're not actually quite there, but
are we hovering close to the edge?
Well, every time we get really, really close, we have a little bit tiny uptick that gives people, gives some people some, hope, right? So, but for the last 18 months or so, since inflation began to climb, investors have fretted over how much the Federal Reserve would tighten their policy, how painful that would be for asset prices. The latest rout, which followed a meeting of the Fed on May 4th, at which America's central bank raised the rates by 50 basis points or 0.5%, right, is very painful.
Yeah, and of course the markets expect the Feds to raise interest rates again, and possibly another 1.9 percentage points this year, even as its balance sheet shrinks fast. And so the more entrenched that inflation becomes, the more aggressive the Feds will have to be. So, American households are worried. They expect inflation to be above 6% a year from now. People are worried.
Yeah, that's right. Higher real interest rates erode the present value of future cash flows. Now think about that statement. The sell-off has been vicious for technology stocks whose valuations rest on expectations of much larger earnings far in the future. For the same reason, prices of bonds with long maturities have fallen heavily. Many speculative assets without cash flows have done even worse.
Yeah, so one question is whether the market slump signals deeper trouble in the economy. I think I kind of gave you my quick and dirty impression of that. America's unemployment rate, they say it's 3.6%, but you know what? We've got 11 million jobs that still remain unfulfilled. And we've got China's zero COVID policy. It's damaging the economy. It's causing supply chain snarl-ups around the world. We're barely out of the fact that it's difficult to even get a new car. Used car market went crazy. These are real situations that we are facing right now.
I mean, even boats. Like
Oh, I know.
try to buy a boat right now. It's insane. We were looking at. I went up with a realtor to look at like lake type property. It's insane. I mean, they're selling mobile homes on a half an acre for $250,000.
Right.
It's like, I mean, are you kidding me? The other question is whether financial market turmoil may eventually amplify economic problems rather than merely reflect them. So, over the past decade, debt and equity markets have played a bigger role in finance, in part owing to tighter regulation that has inhibited risky lending and trading by banks. Most household mortgages now originate outside the banking system and are issued as securities and held by investors. Now, American companies get 57% of their debt funding from investors in bond markets, up from 45% in 2007. Banks play a smaller role as the middlemen in financial markets. Their place are taken by computers and specialized trading firms.
Yeah. So are we in a bear market? We're trying to explain to you some of the technical reasons that our economy is suffering. These structural changes in the way finance works may mean that markets in the future are going to be more prone to bouts of erratic trading and nervous breakdowns. Regulators, as well as plenty of investors, have worried that the new treasury market could seize up in times of stress. That used to be an outlet for letting go of some of the stress in the market. Maybe not so much anymore, and this could cause strains in our real economy. Violent moves in asset markets may have more of an effect not only on people's retirement accounts and company share prices, but also, hey, it could impact their ability to borrow. These are the facts around what I was talking about. COVID was different. We had a strong economy, and it was a single event that caused the dip in COVID, therefore also causing the recovery. I think most of our listeners and most of America know right now there are some fundamentals that are going wrong in the economy right now.
Well, let's summarize it and put it in common sense English.
Yeah.
All right. Number one, when you print a bunch of money, what happens to the value of that money?
So it goes down.
Of course. When you make more of something, think about this. You're making lemonade and you put more water in it. What does it do to the lemonade? It weakens it.
Yes.
So when you print more dollars, it weakens the dollar. All right? That's like, you don't have to be, a rocket scientist to figure that out, right?
And so what have they been doing?
Printing money.
Correct.
So here's another thing. Look, when the only difference is between this and other bear markets is that it shouldn't be hard. Nobody needs a sign, I will work for food. Okay? There's plenty of jobs. That's the difference. There's no issue in the job market, but there's so many other pressures. You got war in Ukraine. You got the government printing money. You've got 10,000 people turning 65, putting pressure on Social Security. Look at the debt clock. Inflation. Supply chain issues.
Debt is another huge one. They're spending money like banshees.
Now, as it applies to the stock market, right? So the idea is, in modern portfolio theory, is to be diversified, right? And the idea is when you get older, you're going to have more fixed income than equities, stocks to bonds, in other words.
Mm-hmm.
What are happening to bonds right now, Karen?
Well, bonds are inverse to interest. So if interest rates are going up, then bonds are going to react with a downward trend.
Yeah, at one point, I don't know where it is right now, but at one point, the aggregate bond index was down 10%. Mm-hmm. So when you're trying to flee to safety, right?
In the stock market.
Yeah.
Yeah.
When that means selling off stock and getting more bonds, right?
But bonds is not a safe place to land right now.
There's no safe place. So that's the scary part in my mind about this as we approach, the sustained bear market. And, what do you do about it? Well,
Right.
we don't have time anymore to do that, but you can go to kpcfinancialsolutions.com, or you could call us at 469-444-3900, or toll free if you're out of state or whatever and you're still using landlines. 877-KPC plan. It's 877-KPC plan. We'd love to have a conversation with you, and we are officially out of time in our podcast. So God bless you and your family. We'll be back next week.
You've been listening to the KPC Smart Money Podcast with Kevin and Karen Christ. To listen to more episodes, visit kpcsmartmoney.com. You can also find the KPC Smart Money Podcast on Apple Podcasts, Google Play, Spotify, and Stitcher.
KPC Financial Solutions is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through KPC Financial Solutions, LLC, a registered investment company. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should be construed as advice designed to meet the particular needs of an individual's situation. KPC Financial Solutions is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by KPC Financial Solutions. Hypothetical examples have been provided for illustrative purposes only. It does not represent a real-life scenario and should not be construed as advice designed to meet the particular needs of an individual's situation.